Okay, let's talk about oil. Here's the executive summary version of this next group of slides. Oil supply is falling short of consensus expectations. This is a big deal. More specifically, U.S. shale oil production is not growing nearly as fast as expected. Further, the ability of U.S. shale oil to respond to a growing global deficit will be lagged and constrained by both labor and capital. I'll show you some related regressions I did here too that put to bed this silly lower for longer argument the bears have. All of which means supply problems are brewing. A temporary shortage and subsequent price spike is likely, it seems to me, in either late 2018 or early 2019. So let's get into all that. I would summarize most of the volatility in the first half of this year by saying that the early bump we saw in prices at the beginning of the year due to the OPEC deal, and then the subsequent drop in oil prices due to floating storage here unloading in the U.S., it was just plain old confusing to a lot of people. As a reminder, prior to the OPEC agreement last November, several OPEC producers, the biggest being Saudi, gamed things a bit by ramping up their production in the period just prior to the cut taking effect, the net effect of which was that they began their cuts off a higher base of production. You can see pretty clearly in this chart that the ships carrying that increased production from OPEC made it to the U.S. in January and February of this year and unloaded, which again was unexpected and confusing to a lot of folks. And yes, that production bump OPEC made before the cut went into effect, and even calling it a cut really it's all kind of sneaky, but it's just part of the game. Here's a quick slide on floating storage, which again further exacerbated things in terms of unexpected increases in U.S. inventories earlier this year. Floating storage is difficult to track, and again, it's all the crude oil that is literally being stored on storage ships around the world. And combined with the ramp in OPEC production late last year just prior to the cut, it meant that numbers for U.S. crude oil storage increased by about 1 million barrels of oil per day for the first 2 months of this year. Floating storage around the world emptied, got sent to the U.S. to be refined or stored for longer, more cheaply. Either way, in the end, the OPEC production cut and floating storage offloadings increased U.S. oil inventories by a huge 56.5 million barrels in Q1 of this year. Again, that surprised the market and then some. Here you can see the impact of those OPEC shipments and floating storage, again in that early year time period. Not only were those purple bars the first 3 months of 2017 higher than the market thought they would be, but my hunch is that because so many hedge funds and traders were upset by being caught off guard, that probably triggered this massive shift to negative sentiment that we're still working through today. The irony is that without those sneaky production surge by Saudi and others before the OPEC quote-unquote cuts, we would be that much further down the road in terms of rebalancing the market. Now, though, we are finally getting traction on U.S. inventory drawdowns. As you can see in more recent months, the rebalancing did not disappear, it just got delayed. From the chart, you can see in 2017 we were drawing down on stocks that we haven't in the previous few years, and the size of those drawdowns is increasing. We are actually seeing the fastest drawdown in U.S. crude stocks in Q2 and Q3 in history. And even though that global floating storage surplus from an earlier slide is now shrinking rapidly, the U.S. oil market did have to work through a higher starting point for inventories earlier this year. All that really gets to the heart of a question I think a lot of you are asking. If supply and demand and all the other fundamentals have been unequivocally positive, like I keep telling you it is, then why oh why have oil prices been stuck in this band of 45 to $50 a barrel for so long? And it's really a two-part answer. Part one of that answer is just sentiment, which is basically a sort of a slightly more professional way to say everyone just hates oil. They just hate it. I don't really have much to say about sentiment. I guess one of the downsides of being overly analytical is that I'm an emotional midget, so I'm going to punt on that whole discussion, and I'll just sort of leave it to somebody else to try and describe why the market might be feeling a certain way. The second factor, though, that explains why oil prices seem stuck, though, is really a little bit easier. It's inventories. Let me explain the background behind this slide, though. First, please understand that strip pricing is not a forecast. Making forecasts or basing valuations based on the futures curve can easily result in wildly incorrect conclusions. Yet it happens all the time. All over Wall Street, people rely on the strip. That's because it's easy, though, not because it's necessarily correct. Email me on this if you want to talk more about it. In any case, I think the question is, if oil's current price on any given day is not just a derivative of the strip, how is it being priced? And this graph is my best guess. It represents a rough but an intrinsically rational way to estimate a fair value for what crude prices should be when oil is trading below the marginal cost barrel, which you may remember is closer to $80 a barrel. This is called comparative inventory analysis, and it basically estimates oil prices based on current supply and demand, as well as current or near-term storage levels, and then sees how that data compares to previous periods of time that had similar characteristics. So, take U.S. oil inventory levels today, see how they compare to the 5-year average for storage, and then see what the WTI price of oil was at other periods over the last 5 years when the difference between them was the same. This is analytically convenient, and while it's arguably simple, it also has a respectable amount of explanatory power to it in the past. So this is my own comparative inventory analysis model that I built. It's a much simpler model than some of the more advanced ones that are out there, but the results are surprisingly similar. So it works for me. Here's how to interpret this. That transparent red vertical band represents where I think U.S. crude oil inventories will be at the end of this December or January. Call it 445 million barrels, give or take, conservatively, which would be about 70 million barrels above the 5-year average. As per this chart, and that purple line of best fit running through those data points, that level could and has supported $60 barrel oil in the past. So, if the market is pricing oil rationally, or at least on a historically consistent basis, then by the end of this year, or January, WTI will trade at $60 a barrel, which is right on that red star there. Now, you may also note the blue diamonds a little below the big red star. Some of those are in the $45 range. The prices below that trend line, below the purple line, were associated with a period of rising oil prices and horrible sentiment as opposed to the current trend. So that sentiment context is important when looking at this too. You can also see here, though, how at least sort of under this coolly rational take in the oil market, you can see how prices should rise as oil inventories fall closer to the 5-year average. So, under this framework, if we can figure out when inventories will fall below certain levels, we can, all things being equal, figure out where oil prices should be. And to fast forward here, once U.S. inventory levels are equal to or below the 5-year average, oil prices should move from that red star up and to the left along that purple line, eventually approaching triple digits. Again, according to this sort of modeling. However, and this is a fairly big asterisk, even this approach is still subject to one of the same chronic problems inherent in oil inventory reporting, one of which is that it relies on data that is several months old. Another big issue is that relying on this sort of thing to explain current WTI pricing also violates one of the core tenets of finance in general, which is really that prices should be forward-looking. This, again, by definition, is really all backward-looking. So I personally think it's a little too simplistic to accurately and consistently predict prices with this, but right or wrong, I mention it because I believe it's this or something like this that a lot of high-frequency trading algorithms in the sector really seem to key off. It could be something a little bit more related to gasoline or oil products. It's hard to tell. This is just, again, oil per se here. But this idea of the shale band, where WTI prices have seemed stuck between 45 and 50 forever now, that comes from here. So if you believe in the shale band theory, then I guess you can also consider this to be noticed that the band will soon be no more, because WTI prices should, according to this framework, start moving north or outside that band within a month or two. And let's be clear, it absolutely is algorithms in the paper market as opposed to the physical oil market who have the most influence in setting daily oil prices. And I say that because first, the futures market, that paper market, is 30 times bigger than the physical oil market. It's enormous, and it's a giant net negative for the system, if you ask me, but that's another slideshow. The point is the paper market dwarfs the actual oil market. So in the short term, things like market length and trader positioning, they can become more important to oil pricing than fundamentals, again, in the short term. Also, by definition, now that computer algorithms control, as per that red circle there in this Wall Street Journal graphic, now that algos control more than 55% of the energy futures market too, they are, by definition, going to be the dominant force when it comes to setting oil prices. They've got to key off something. Inventory analysis seems like it could be one of those factors that algos key off. And yeah, the negatives of letting the algos run amok is a whole other slideshow, but the reality is also that they're just part of the deal these days. And actually, wouldn't even need another slideshow to talk about the algorithms. Just go watch the movie The Big Short. You'll probably learn everything you need to know about how counterparty risk can make Wall Street way too slow to correct some very complicated models in spite of overwhelming evidence to the contrary. Okay, moving on. Comparative inventory analysis like that seems reasonably explanatory in the trough of the oil cycle, like now, but it's not real predictive when it comes to timing. The North Star, to me, when it comes to predicting oil prices in the long term, is still that marginal cost of supply. Prices are well under that now, though, in which case that framework that we just walked through seems to explain some things right now, even if it doesn't tell you everything, like what you really want to know, the expected rate of change of inventory, so you can sort of get a gauge on where prices would be. All of which brings me to this. In 2017, we are seeing a massive reduction in global oil inventories and a likely return to historical averages by the end of this year. Here is a graph of inventories for the OECD countries, basically the top 3 dozen market-based democracies, not just the US. Couple of quick bullets to underscore just exactly how much oil is being drained out there from inventories around the world lately. And this is really US specific, so let's start there. In the US, in 2017, through this past week, we have never seen a bigger peak to trough decline in oil inventories. US oil storage has fallen 79 million barrels from the peak, which was that spike in Q1 caused by OPEC imports related to the production cut, from that peak through last week. And that is even after absorbing 23 million barrels of oil that Uncle Sam put into the system from the country's Strategic Petroleum Reserve, the SPR. So both forward prices and my own estimates indicate significant drops in Q4 as well. I've been expecting we'll draw at least another 40 million barrels here, making 2017 the year with the highest wire-to-wire inventory drawdowns in the U.S. in history. And again, in spite of that massive OPEC build in Q1. And I say I was expecting that, but I should probably bump that number up because U.S. inventories have actually fallen 32 million barrels in just the last 4 weeks. By way of reference, a 50 million drawdown in U.S. oil inventories in Q4 would be about 150 times the average seasonal drawdown for the same period over the last 14 years. So the pace of this current drawdown is unprecedented here. It's also the same story in the rest of the world. When it comes to inventories in the rest of the world, which are difficult to track accurately at the country level, I'm just going to sort of skip over how you could create a ratio for the rates of change between inventories here and overseas, and triangulate on where global inventories really stand in the real time. But instead, we'll just jump to this. That quote is from the head of OPEC just this past week. In the last 4 months, global inventories have fallen by 130 million barrels, which, historically speaking, is an extremely fast pace. In fact, if you did another comparative inventory analysis, only instead of focusing on just the US like I showed you, your data set consisted of the entire world's inventory storage, you would see that at the end of 2017, the world's oil storage levels will have fallen to the same storage levels that just a few years ago supported global oil prices above $90 a barrel. Again, not a forecast for $90 a barrel, just an interesting observation. And the real importance of that little nugget is that it confirms that inventories in the rest of the world are falling off at a pace even faster than the US. And you know that because US storage accounts for more than half of the inventory above the OECD 5-year inventory average, and because the US is the last place in the world that storage will drain from, because it's the cheapest place to store oil. So let's just sort of skip the raw numbers, which are probably pretty abstract anyways, and just look at rates of change. By definition, by the time U.S. oil inventories reach their 5-year average here, global inventories will be in significantly greater deficit, well below their 5-year band. So a good question at this point might be, once they are in deficit, how will global inventories get back in balance? Especially if OPEC or OPEC and Russia extend this current production cut agreement like they're saying they will until the end of 2018. And the answer cannot be U.S. shale oil. The math just doesn't work. As per those comments from the OPEC SecGen, global inventories are declining at a rate of drainage of just over 1 million barrels of oil per day. And there simply is no quick and easy way for the 5.5 million barrels of oil production per day coming from U.S. shale to grow enough to backfill an inventory hole caused by a 1 million barrel of oil a day decline, nor will the other 90 million barrels of production from the rest of the world be much help either, both because it takes a while to turn that spigot even if oil is priced close to those break-evens, and because 45 million barrels of that market, i.e. OPEC and Russia, are going to be intentionally sitting on their hands in that production cut agreement. All of which makes $50 WTI sound a bit ridiculous, especially because the ghost in the machine, the magic U.S. shale production that will appear at the end of the play to plug the big hole in the plot, it's just not coming. U.S. shale production is not growing nearly fast enough at these price levels to stop what's coming. More on that in a second. But first, another reminder. The more global inventories decline, the more susceptible the oil market becomes to supply shocks. Unplanned outages are right now at a 6-year low, in spite of more risks building up in the Middle East. Leaving aside the tension between Iran and Saudi, this newly developing conflict between the Kurds and the Iraqis, as well as the U.S.'s likely non-renewal of key parts of the previous Iran deal in January. The market's also assuming Libya will do 1 to 1.2 million barrels a day throughout 2018, which seems questionable. Their two political factions are having talks in Tunisia that seem to be breaking down lately. I think, in terms of talking about other unplanned suppliers, I think, unfortunately, the best way to sort of morbidly summarize the risk to Venezuela's 2 million barrels of production per day is that people are so hungry there, they are breaking into zoos to find animals to eat. Really, Google it. So, the point is, color me skeptical that the maintenance of Venezuelan oil infrastructure has been on point the last year. To say that the oil market has been lulled into a false sense of security here is a large understatement. And then, sort of to tie all these things together. Even though you can see in the data all this happening, it's as though because those inventories are not at the 5-year average levels yet, the algos are not responding and boosting oil prices yet, or something. I don't know. I really can't explain it. But I do know it's not because we're missing something. And I also know the only answer to that question of how do things get back in balance once inventories have fallen through that equilibrium point is the market has to incentivize a lot of oil to come online quickly through much higher oil prices. But wait, you're saying, what about all this increased oil production out of the U.S.? Won't that fill this coming hole in supply? And I'm glad you asked. The short answer is no. The U.S. will not be able to fill that gap. U.S. shale is not growing nearly as fast as expected, and its response to a growing global deficit is going to be lagged and constrained by both capital and labor. And why do I say this? Why do I believe this? Because you can see it in the data. You've got to dig a little bit, and then maybe you have to do a couple of regressions to see for yourself whether or not the consensus thing on oil makes any sense. But more on those in a bit. So, again, oil supply is going to fall short of consensus. It's important to understand oil prices are where they are today for a lot of reasons, but the primary one is because of the belief that U.S. shale oil production is growing rapidly. That belief, which is common on Wall Street and throughout the media, it comes directly from the EIA, the Energy Information Administration, the statistical arm of the U.S. government, which forecasts these sorts of things. And based on the EIA models, that narrative gets reinforced and amplified through confirmation and selection bias, which, as you know, sort of runs rampant on Wall Street. This is a powerful narrative. The consensus forecast is that U.S. shale will simply continue expanding its production unabated for the next few years, which then means oil prices will stay low, in which case it doesn't matter that OPEC wants significantly higher oil prices. And apparently it's being interpreted to also mean that we can just sort of ignore whatever else may be going on with the other 95% of oil production around the world that is not the U.S. The reality, however, is that this narrative is not true. It's not even close. Here is U.S. oil production growth in 2017 so far. It was up 2.8% in the first 6 months of this year. That little jump you see in the most recent bar from July 2017, that little jump up was exclusively from the Gulf of Mexico. That was a big traditional offshore oil drilling project whose planning began years ago. It's not shale oil, so you can't count that. And so I think you're probably looking at this and saying, never mind that weird little Gulf of Mexico blip. Where is this massive growth in U.S. shale oil production I keep hearing about? And the answer is it doesn't exist. To be clear, U.S. shale oil production is growing, but only a little bit. It's just nowhere near as fast as consensus as the EIA and Wall Street believe. And if you're saying to yourself at this point, all right, that just doesn't jibe, I must have heard at least a dozen times or read a dozen articles this year about how oil production is growing in the U.S., and all I'm saying to you is the data doesn't lie, and here it is. It has been extremely underreported, but if you actually look at the data, you'll see a surprising thing. Total U.S. shale production has been flat for now 7 months running, and nobody on Wall Street or any of the big reporting agencies would have predicted this 6 months ago. So it's clear to anyone bothering to even track the oil market lately that recent production growth claims out of U.S. shale have been exaggerated. And the reason for that exaggeration gets a little bit wonky, but stay with me here. Short version is that the EIA, again, the Energy Information Administration, the statistical arm of the U.S. government, puts out weekly forecasts of oil production. These reports, as silly as it sounds, are watched extremely closely by the fast money crowd. The kind of people who would rather trade than think, apparently. The problem is that those weekly EIA reports are based off a model that has some big short-term flaws. And that's not due to incompetence or government bureaucracy or any other cynical takes on this issue. It's just due to the complexity of what these guys are trying to model. So the weekly EIA reports have a big problem, and I'll show you in a second. You can also tell their model is flawed by looking at other better data that they themselves publish. the EIA also puts out better, much more accurate monthly production data on a lag of a couple of months that revises its own previously forecasted numbers and reflects what oil production actually was in the U.S. And it's that more accurate, lagged monthly data that is telling a different story than these weekly forecasts the fast money guys respond to, and which is based off a flawed model. So those headlines from the summer saying that shale is growing over 100,000 barrels a day were based on estimates from the EIA, specifically from their DPR, their Drilling Productivity Report, which, again, is derived from a flawed formula. In a perfect world, there should be no daylight between the two lines on this chart. The blue line shows data from the flawed weekly projections, and the orange line shows what the actual data showed once all revisions are incorporated and it's published a few months later. So, orange is reality, blue is the forecast. And the nutshell version of what I'm saying here is that the blue line and the orange line have to meet. But with oil prices stuck where they are, then the blue line, which again represents production forecast, has to come down to meet the orange line. So the EIA numbers, which are relied on so heavily by Wall Street, are coming down to reflect that shale oil growth is not growing anywhere nearly as fast as everyone, except we very few, as fast as we thought it would, or they thought it would. And oil prices have to rise because supply is significantly less than expected. Just in case you're curious, here is the flaw in the IEA weekly model. I'll try to summarize it. As drilling activity rises in the U.S., the EIA overestimates future production by taking the last month for which it has compiled production and then using changes in the rig count since that time to forecast the next 4 months. But changes in the rig count only impact production 6 to 9 months later, the net of which means this forecast is going to be way off in periods when the rig count is changing rapidly, like now. Here are a couple of data points to underscore the problem with this discrepancy between the weekly forecasted numbers and the monthly actual numbers. I'll just summarize them by saying U.S. shale oil growth is going to end 2017 at about half the level it appears that the EIA and Wall Street thought it would. That's a huge miss, and here's the net of what that wonky little problem means. The point is that these sorts of modeling issues have led the consensus to forecast that U.S. shale growth in 2017 and beyond is going to be much higher than it actually will be. I see U.S. onshore production ending the year at a rate that is from 300K to 500K lower, conservatively, and that's barrels of oil per day, than consensus estimates. And if that overstatement ends up being 500,000 barrels a day, for 120 days this year, then that's a massive 60 million barrel overstatement in projected storage inventories too. So let me step back. So this is a big deal because it means A, storage is emptying faster than expected, and B, because growth in U.S. shale is really one of the main plug figures which the EIA, the IEA, and OPEC, the big three triumvirate of oil reporting stats, U.S. shale is one of the main plug figures that each of those guys use to make sure supply meets global demand the next few years. All three agencies' forecasts depend on some massive increases in U.S. shale oil volumes within just a couple of years, meaning that these increases are going to be necessary to meet demand. But, expectations for that multi-year increase started falling dramatically short 6 months into things. So looking out a bit, the implication is that if U.S. shale stalls from anything other than a really fast ramp, then we're in a long-term oil shortage scenario. And I kind of feel like we're seeing this happen right now, real time, yet not a lot of other people seem to be noticing. Okay, bottom line. If you take consensus expectations for oil supply, as shown in this table I put together, and you adjust those consensus expectations to reflect just the realities of slower than expected growth in U.S. shale oil supply, as per that purple line of cells at the bottom of this table, then it becomes evident that the world is actually undersupplied with oil today, and that we're really on a knife edge in terms of our ability to keep this deficit from getting away from us, excuse me. And I say that knife edge because all I adjusted here in the consensus expectations was U.S. shale oil supply. If OPEC plus Russia specifically, were to extend their production cuts from the end of Q1 of 2018 through the end of the year, like they're talking about doing now, those 2018 quarterly deficits increase. That's another adjustment. We're not going to talk much at all about demand here, but keep in mind that it's a whole other part, a half of the supply-demand balance that historically is also chronically underestimated every year. And increased demand would make this consensus adjusted deficit worse. So another adjustment. I'm also not even questioning consensus assumptions for supply out of the rest of the world here. But a proper reckoning here would mean that those would likely need to be adjusted too. Even if you assume production out of Libya and Nigeria can stay elevated in 2018, and that Venezuela somehow avoids imploding, so all three meet the expectations that are already baked into here, I think it's important to recognize that the White House is very much on a path right now to not renew sanction waivers on Iran when they come up again in January. And that the White House could get other countries in line pretty quickly again on those sanctions if, for instance, resisting us meant they got locked out of our capital markets. So if President Trump goes down, or continues down, I should say, the same path he already appears to be on, then that's a big potential adjustment we'd have to make to Iran's contribution to the world supply of oil. That's about 3.8 million barrels of oil per day. So again, another material adjustment downward from this table. Finally, I would also just point out that there is absolutely room for U.S. shale to grow from here. Even if it was meeting expectations for 2017 growth, which it isn't, U.S. shale it's not the boogeyman, and it's not all or nothing. The market needs U.S. shale oil to be a reliable and important part of the global market for years to come. To close out, at least on this whole problem with production estimates, there is, in my mind, a much better way to estimate supply and demand balance in the U.S., better than relying on those sort of crazy, crappy weekly EIA production reports, which seem to be making the market kind of stupid. And that is as per this graph. This is based on a different data set from the EIA that I took and created. This is basically a sum of all liquid hydrocarbons in U.S. storage. I think I'm biased, but I think this is actually the best indicator of the state of balance between supply and demand here in the U.S., specifically because it smooths out things like refinery maintenance, summer driving season, shifts between crude oil and gasoline, transfers in and out of the Strategic Petroleum Reserve. It won't pick up any unusual activity in imports or exports, but over the long run, I'm sort of assuming they wouldn't have a huge impact on things anyways. I also used a 52-week average to get rid of any seasonality in here, and though that obviously makes it something of a lagging indicator, the upshot is, or the way I justify that is, well, it takes a ton to move a 52-week average. The point being that whatever signal you get out of this thing is going to be pretty reliable. Okay, and so how you interpret this is by basically looking at the slopes. The slope of this line peaked in November 2015. I'm talking the slope now, not the actual peak of the line, but the slope. That November 2015 basically shows you the point where U.S. supply most outstripped demand. Since then, the slope of that line, though still positive, has been, as you can see, on a sort of a slow and steady decline ever since, which basically implies that for almost 2 years now, the size of the oil oversupply in the U.S. has been steadily decreasing. All right, good reality check, right? The more interesting stuff, though, it has happened more recently. Starting this summer, the slope of that line finally flipped from negative to positive. meaning that since July specifically, the U.S. has been moderately undersupplied. Over the last few months and weeks, you're also seeing an acceleration of the inventory decline here in the U.S. as well, which means, again, demand is now outpacing supply by about 300,000 barrels of oil per day. And by the end of this year, that deficit should increase even more. So my points are really, there are other better ways to see what's really going on in the U.S. oil market than hyper reacting to every weekly EIA report. B, those other ways, like this one, corroborate trends that are also pretty bullish for oil prices. And C, these recent drawdowns in U.S. storage, they're not a short-term phenomenon. So high level, just consider this another big chip on the side of the scale for higher oil prices soon. Quick slide here, and that I'm going to let you read on your own. The top 12 bullish signs for oil prices, and don't worry, I'm going to tackle the big two, the main two bearish points in the Q&A section coming up. Here is also a quick list of things that could finally force a change to this overbearingly negative sentiment in the market about oil and in E&Ps in general. And then a little summary slide to close out this video. I'm not going to read it to you. If you need a little pep talk from your portfolio manager, there you go. Okay, that's the end of this particular video on oil. Next up, we'll get into Q&A. Specifically, I want to address some of the questions that you all have asked, and starting with one of them, that one of the biggest things that I feel like the oil bears are mistakenly hanging their hat on. So grab a snack and come right back.